Welcome to the Deep Dive. Today we're tackling something that can feel pretty complex. Foreign currency translation in financial reporting.
Yeah, it's definitely got its nuances. We're working from foreign currency translation covers both US GAAP and IFRS standards.
And our mission really is to unpack the basics. How do companies actually translate their numbers when they're operating across borders using different currencies?
We'll be looking hard at what defines a company's functional currency, that's key, and then how exchange rate shifts ripple through the financial statements.
Right. And this matters for you if you're, say, an investor looking at a multinational company.
Or involved in international business yourself.
Exactly. Or even if you're just curious about global finance, understanding this translation piece is, well, crucial for seeing the whole picture.
Couldn't agree more.
Okay, so let's dive in. Foundational concept first. Functional currency. What's the core idea there?
Right. So the functional currency is essentially the currency of the main economic environment where the company operates.
Okay, the main economic environment.
Yeah, and that's important because it's not always just where the company is legally registered. You could have, say, an Italian subsidiary, but if its primary business, its sales, its costs are all driven by what's happening in maybe Canada, its functional currency might actually be the Canadian dollar.
Interesting. So less about the legal address, more about the economic reality?
Precisely. It's about where the financial heart beats, like you said.
Okay. And the source mentions specific indicators for figuring this out under both IFRS and US GAAP. What are accountants looking for?
Well, there are a few main things. First, the currency that, primarily influences sales prices.
Yeah.
Then the currency of the country whose competitive landscape and regulations really shape those prices.
Right, the market forces.
Exactly. Also, the currency that mainly dictates costs, labor, materials, that sort of thing.
Makes sense.
And finally, where does the cash from operations usually end up? What currency is it typically held in?
Okay, so it's tracing the money flows and the major influences on them. Now, US GAAP has this presumption, right, about the US dollar for foreign operations in the US.
Yes, that's a specific point in US GAAP. If a foreign-owned operation is physically located in the US, the starting point, the assumption, is that the US dollar is its functional currency.
But it's just an assumption.
It's just an assumption. It can be overcome if the evidence, those indicators we just talked about strongly, points towards a different currency being the primary one for that specific operation.
So the default can be overridden. What about situations where the functional currency isn't the local currency? You mentioned the Italian subsidiary with a Canadian functional currency. Can you give another example?
Sure. Think about a foreign operation that's really just an extension of the parent company. Maybe a UK parent sets up a small sales office in Spain.
Okay.
Now, if that Spanish office mainly sells products priced in British pounds, its costs are driven by pounds, and almost all the euros it receives are immediately sent back to the UK.
Then its functional currency might still be pounds.
Exactly. Even though it's operating locally in euros, its economic reality is tied to the pound.
Okay, that clears it up. And what if the functional currency is the same as the parent's reporting currency? Say, a U.S. parent and a foreign OBI that also uses USD functionally.
Well, in that scenario, you don't have the big translation process for the entire financial statements that we're about to discuss.
Right.
Instead, if that operation has transactions in, say, euros or yen, those specific transactions are treated as foreign currency transactions, which is a slightly different accounting treatment we'll get to.
Got it. So determining the functional currency is step one. And if it's different from the parent's reporting currency, then we need to translate the whole set of financials.
Exactly right. That translation is necessary to consolidate everything, to give shareholders a single, unified view of the global business in the parent's currency.
Okay, consolidation. Makes sense. So how does this translation actually work? What rates are used?
It's a bit of a mix, actually. Generally, assets and liabilities on the foreign operations balance sheet, they get translated using the current exchange rate.
Current meaning.
Meaning the spot rate on the balance sheet date the end of the reporting period.
Okay, and income and expenses.
Those are typically translated using the rates that were in effect when the transactions happened. But, doing that for every single transaction is often impractical.
I bet.
So quite often, companies use a weighted average rate for the period, assuming it's a reasonable approximation.
An average rate. Okay, what about equity?
Equity accounts like common stock, additional paid-in capital are usually translated at historical rates, the rates that existed when that equity was originally issued or those transactions occurred. Retained earnings is a bit different. It's more of a plug figure that accumulates over time.
Historical rates for equity, current for assets, liabilities, average for P&L. Quite a mix. Now, the source talks about the CTA cumulative translation adjustment. What's that?
Right, the CTA. So because you're using these different rates, current for assets and liabilities, historical for equity, the basic accounting equation, assets, liabilities plus equity, won't naturally balance after translation.
Oh,
The CTA is basically the plug number, the adjustment needed to make the balance sheet balance again. And importantly, it doesn't go through the income statement.
where does it go then?
It's recorded in other comprehensive income, or OCI, which is part of equity, but it's separate from net income.
So it accumulates in equity, kind of reflecting the overall impact of currency moves on the net investment in that foreign op.
Exactly. It's a running total of those translation gains or losses over time, sitting in the equity section. Investors really need to look at OCI for multinationals.
And these exchange differences that build up the CTA, they just stay in OCI?
Generally, yes. They stay parked in OCI as part of that cumulative translation adjustment until the company actually sells or substantially liquidates that foreign operation.
And then what happens?
At that point, the accumulated CTA related to that specific operation is reclassified out of OCI and recognized in profit or loss, usually as part of the gain or loss on the disposal.
Okay, so it hits the income statement eventually, but only upon disposal. That's a key distinction. Let's shift gears slightly now to foreign currency transactions. How are these different?
Good question. Translation, as we said, is about restating a whole set of financials. Foreign currency transactions are individual deals.
Like buying or selling something.
Exactly. Buying inventory, selling goods, taking out a loan. Any transaction where the price is set or it needs to be settled in a currency other than the company's own functional currency.
Okay, so a U.S. company with a USD functional currency buys from a German supplier in euros. That's a foreign currency transaction for the U.S. company.
Precisely.
How are those recorded initially?
At the very beginning, when the transaction occurs, you translate the foreign currency amount into the functional currency using the spot exchange rate on that specific date.
Rate on the day. Got it.
So that U.S. company buying in euros records the purchase in USD based on the USD rate that day.
What happens later, say, at the end of the reporting period if they haven't paid that German supplier yet?
Right. So for monetary items, things like cash, receivables, payables that are denominated in a foreign currency, you have to remeasure them.
Remeasure?
Yeah, retranslate them using the spot rate at the end of the reporting period.
Yeah.
So that euro payable needs to be updated on the balance sheet to its current USD equivalent.
Okay. And what about non-monetary items, like if they bought equipment?
Non-monetary items carried at historical costs, like PP&E or maybe some inventory, generally are not retranslated after the initial transaction date. They stay at their historical translated cost.
So only the monetary stuff gets updated for rate changes each period. What happens to the gains or losses from that remeasurement if the euro strengthens or weakens against the dollar?
Generally, those gains or losses, the difference between the original recorded amount or the last reported amount and the new amount based on the period end rate, go directly into profit or loss.
Ah, okay. So these transaction-related gains and losses hit the income statement in the period the rate changes.
Yes, that's the key difference. Translation adjustments generally go to OCI, while these transaction gains and losses typically hit net income.
Big difference for analysis. Are there exceptions where transaction gains losses don't go to P&L?
There are a few, yes. For example, if a company uses hedging instruments like forward contracts specifically to hedge a foreign currency risk and it meets strict hedge accounting criteria, then the gains or losses on that hedging instrument might go to OCI to offset the change in the hedged item. Also, certain long-term loans between a parent and a subsidiary, if they're considered part of the net investment, their exchange differences might go to OCI too.
Okay, so some specific hedging and intercompany situations can also route things to OCI.
Yeah.
To know. The source also mentions hyperinflation. What's the deal there?
Right, hyperinflationary economies. If a foreign operation's functional currency is one experiencing hyperinflation, think extremely high, accelerating inflation. Then there's an extra step. Before you translate the financials into the parent's reporting currency, you first have to restate that foreign operations financials to reflect the current purchasing power of its hyperinflationary currency.
Restate before translating. Why?
Because in hyperinflation, historical costs become meaningless very quickly. You need to adjust everything for the loss of purchasing power first to get a more economically relevant picture. Then you translate the restated numbers.
That makes sense. Trying to translate wildly inflated historical numbers would give you nonsense. Okay, let's go back to the big picture. How does all this affect the main financial statements overall?
Well, on the balance sheet, you see assets and liabilities at current rates, most equity at historical rates, and that CTA plug-in OCI capturing the difference. Big impact on reported equity.
Right.
On the income statement, translated revenues and expenses affect reported profit. And importantly, those transaction gains and losses we discuss often flow directly through here, adding volatility.
And cash flows.
The statement of cash flows essentially shows the foreign ops cash movements translated into the reporting currency, usually using average rates for the operating flows. The key for anyone reading these statements is really separating the OCI translation impact from the P&L transaction impact. They tell different stories about how currency is affecting the company's performance and position.
And remembering that CTA eventually hits P&L on disposal.
Exactly. That can be a significant one-off item when it happens.
Okay. We've covered a lot of ground-determining functional currency, the mechanics of translation versus transactions, the role of OCI and CTA, even hyperinflation. It really highlights how vital this is for understanding any global business.
Absolutely. These aren't just, obscure accounting rules. They directly shape the numbers that companies report and that investors rely on. The impact of currency fluctuations is real and can be substantial.
So wrapping up this deep dive, maybe something for you, the listener, to think about. As businesses become even more globalized, how might these rules around foreign currency translation need to evolve?
Yeah, and what are the biggest practical challenges companies face today in just managing and reporting all this complexity? It's certainly not getting any simpler out there.
Definitely food for thought. Thanks for joining us on this deep dive.